Hello folks, Steve Lynch here with Discover Options. Welcome to this presentation of 3 different S&P 500 market timing reports for advanced options traders. This will be for Friday, May 25th, getting ready for Tuesday's open on the 29th, just after Memorial Day. I hope everyone had a great Memorial Day. And presented material, of course, is for educational purposes only. It should not be construed as personalized financial advice. Past results not necessarily indicative of future performance. With that said, please hit the subscribe button. That way we will get you alerts whenever we come out with new videos. And then also we have an ebook, a free ebook, Simple Steps to Options Trading Success. Just click the link, give us your info. We'll get that right out to you. It was co-authored by myself and Jim Graham. All 3 market timing reports pertain to the current condition of the S&P 500 index. And here it is. We define it in 3 different fashions: price action, trend, and then the stochastic situation. In terms of price action, Thursday was a downswing day with a lower high and a lower low, and then Friday was an inside bar with a lower high and a higher low. Now that price action took place while we are above the 50-day simple moving average. And in terms of the stochastic situation, we are between 60 and 100, and we are underneath the 3-day percent D. So we're trending downward on the stochastic. We have an inside bar following a downswing bar in the price action, but we're above the 50-day simple moving average. Altogether, this condition, as defined right here, has occurred just 58 times since January of 2000. And so that will be our sample that we use in the studies that we're going to do right now. Let's first go to the Condor and Butterfly timing report. This answers the question: is now a good time to put on and begin a Condor or a Butterfly campaign? And so let's just take a look here. So since January of 2000, we've had 4,623 daily closes of the S&P 500. Now of these, 64.8%, not quite 2/3, have been favorable bars for selling premium, where the actual 21-bar subsequent movement was less than what was being implied by the option prices through the SIBO skew-adjusted VIX. Okay, so again, almost 2/3, not quite, almost 2/3 of all the bars in the S&P 500 going back to January 2000, all right, have been favorable ones for doing butterflies and condors. Now, also during that time, our current condition, as I explained, has occurred just 58 times. Now, of those 58 occurrences, okay, and I messed that part up, 75.8% of the bars have been similarly favorable for option premium selling. 75.8, and you can see that right there. I messed it up in the narrative there, though. 75.8. So this implies an option premium selling edge of 11%. 11%. Statistically, it's more likely than usual that the current market condition will end up being a favorable one for market neutral option premium selling through strategies like the butterflies and condors, okay? So, seemingly a green light in that regard. Let's go to the bull put spread timing report. This is for those of you that like to sell puts in the S&P 500 in various fashions. One way is to just do a bull put spread. Selling puts a standard deviation out of the money, maybe 30 days away, and that's what the report here is predicated on. 30 days out, a standard deviation away. So here we go. As I explained, we've had 4,623 daily closes of the S&P 500. Of those, 82.8% have been favorable bars for selling put premium, like I explained, where the actual 21-bar downside movement was less than what was being implied by the CBOE's skew-adjusted VIX, adjusted, for the downside. All right, because the skew-adjusted VIX implies a certain downside movement. And it's a favorable situation if the market does not go down that far. And that's what's happened 82.8% of the time. Now, also during that time, since Jan of 2000, our market conditions occurred 58 times. Of those 58, get this, 93% of those bars have been similarly favorable for selling put premium. In that fashion, 30 days out, standard deviation away, where the market did not go down and hit that short strike down there. So this implies a put option premium selling edge of 10.2%. Statistically, it's more likely than usual that this condition will end up being a favorable one for selling put premium. Okay. All right, let's finally go to the market likelihood report. What we do here is we just, we're examining where the market is likely to go, up, down, or wobble around a bit in terms of volatility. And so we begin with the top left portion of this, where we're looking at, those 4,600 occurrences, 4,623 occurrences. And so let's just go to the top line here. Since Jan of 2000, of those 4,600 and here we go, 4,626 occurrences, if you were to take any close and go 5 bars later, you would see on average, when you average it out, 0.1% increase from close to the close 5 bars later. 0.1% increase because the market's been bullish, right? It's been going up. On average, you've seen a 5-day rate of change of 0.1%, 0.1%. The 2-week rate of change, on average, has been about 1/5 of a percent, 0.19, and the 3-week rate of change has been 0.28, a little bit over 1/4% change in the course of 3 weeks. That's on average. Okay, now let's go and look at our current condition. Our current condition that's occurred 58 times. That's over 1% of the total population. Of that 58%, of those 58 occurrences, the average 5-day change was over 1/4% to the upside. Okay, a difference of 0.17 to the positive. Now, how much is that? A lot greater? Going from 0.1% to over 1/4%, that works out to be roughly 1/5 of a standard deviation to the upside, 0.21. This is the Z-score, we call it. And it represents a percentage of a standard deviation. And 1.0 is a full standard deviation to the upside. Negative 1.0 would be a standard deviation to the downside. So this is to the bullish side. Not even 1/4 of a standard deviation to the upside. So nothing to write home huge about. The 2-week is at 0.37 to the upside instead of 0.19. So a little bit more bullish. And then the 3-week change is at 0.93, almost a full percent to the upside instead of a little bit more than 1/4. And that represents almost 1/2 a standard deviation to the upside, which is getting better. So we definitely see a bullish bias. We see a bullish bias to a small degree. Not even 1/2 a standard deviation to the upside, but it is something. It definitely is something. We're going to get to volatility later, by the way. Now let's carve up these 58 occurrences between those where the market went above the high of that inside bar that we just saw on Friday, and then also those that went below the low of the inside bar. And so of those 58 occurrences, 31 times the market went above the high of that inside bar. And when that happened, you saw a 5-day change of 1%, a 0.99, 0.93, and then almost 1.5% on the 3-week rate of change, the 15-bar rate of change. That represents a Z-score of, look at this, a full standard deviation, more than 1/2 a standard deviation, and something pushing a full standard deviation on the 3 weeks. That's pretty darn good. That's a much stronger bullish bias if the market penetrates the high of that inside bar. You see that? If the market goes below the low of that inside bar, it's done that 26 times in the past. We see then a 5-day rate of change that's negative, 1/4% or a little more to the downside. Okay, 2-week of change about flat. 3-week rate of change is still high, 0.67, a bit higher. So the z-scores there are, not even half a standard deviation to the downside. And then, of course, the 3-week is barely a quarter of a standard deviation to the upside. Nothing to write home huge about. All in all, a bullish bias. In terms of volatility, let's come over here to the realized volatility. We have a baseline volatility of an average realized volatility of something between 15 and 16% annualized. That's the volatility rate over the course of 5, 10, and 15 bars. Now, our current market condition results typically in and these are annualized volatility levels taken from 5, 10, and 15 days. We're looking at something in the high 12s. Something in the high 12s, which is much less than the benchmark of something in the 15s. And then if you carve it out in terms of exceeding the high of the inside bar or the low, you have something in the 11s, pushing the 12s. And then if it goes down below the low, now we're looking at something in the 13s. In terms of where the VIX is, interesting, the VIX is at 13.39. Okay, that's a 21 bar or a 30-day look. That's looking forward, but that's on an annualized basis. And we note that the VIX is higher than what our current market condition typically realizes on average. We see that. And so hence that's perhaps why we have a perceived edge in terms of condors and butterflies and bull put spreads, is the VIX is higher than what this market condition is typically penciled out in terms of realized volatility. Okay, I hope that's helpful for you in your trading coming up. I'm Steve Lentz with Discover Options. Thanks for joining us today. Have a great week. Bye-bye.